All right, we have a special case, which is the transfer of non-like-kind property. And this is just an issue for the person who gives it, not the person who receives it. We're going to treat it as two separate transactions, assuming or pretending the taxpayer sells the non-like-kind property before the like-kind exchange and uses the cash proceeds in the like-kind exchange. So, one, we're going to pretend you sell the non-like-kind property for its fair market value. Two, you pretend you take the cash from the sale and use in the like-kind exchange. On the first transaction, you have a gain or loss. So when you're doing that pretend transaction. All right, so this will make more sense after we take a look at it. So Avery trades an apartment building. So here's Avery, and then we have Bailey. So Avery trades an apartment building, fair market value, $337, cost $240, and basis $85. To Bailey for a warehouse, fair market value $314, cost is $220, and basis is $180. Bailey also assumes Avery's debt of $28,000. So I'm going to say, here's that debt of $28,000. Avery transfers stock to Bailey. There's also going to be stock. Fair market value 5, basis 1. It's been owned for 3 years. Avery and Bailey use these buildings in their business and have owned them for several years. Okay, so let's go through and think about first, we're going to pretend like Avery sells the stock for 5, and then she would have a gain of 4. So she has a basis of 1. We're pretending that she sold the stock, got her $5,000, had a basis of 1, and now has a gain of 4. All right, so that's kind of what we're assuming first, and that would be a long-term capital gain. All right, so we're going to determine from Avery's perspective first the amount realized. So the fair market value of the new asset plus the fair market value of any boot received. So the fair market value of the new asset is the $314, and the boot received is the assumption of debt by Bailey. So when someone takes on your debt, that is when you receive boot. And so she gets $342. The fair market value of the new asset plus the fair market value of the boot received. And so the boot received is this debt that we're talking about right here that Bailey is taking on. And then the $314 is here. All right, what is Avery's basis in the property transferred to the other party? Well, her basis was 85. So we have the 85, which is her basis in the old asset that she's transferring, plus the fair market value of any boot given to the other party. The boot given to the other party is the stock. So we have the 5,000 in stock for a total of 90. The realized gain or the loss is the amount realized of 342 minus the 90 in basis that we just calculated, or 252. Now this is the first time we've seen this netting of boot. So we're thinking about the boot received. And when we're thinking about the boot received, we're thinking about how Bailey took on $28 or $28,000 of debt. So that's our 28 in type 1 boot that we are netting with the 5,000 in boot that we gave. Okay, so we gave boot the $5,000. We're netting those together. There was no type 2 boot, so we have 23. The boot we received was effectively 23 because we had 28 in debt relief, but when we net that against the boot that we gave, we only get 23. All right, then the recognized gain or loss is the lesser of the realized gain or boot received. So for Avery, we're going to have recognized gain of 23. What's the character going to be? It's going to be unrecaptured 1250 at 25% because of how she's using it in her business as a sole proprietor. All right, the deferred gain or loss is the realized gain or loss of 252 minus the recognized 23 or 229 in deferred gain. Then finally, her basis in the new asset is the fair market value of the new asset. So the fair market value is the 314 of the asset she's getting. So 314 minus the deferred gain of 229 or $85. Okay? And so we would have that $4,000 long-term capital gain from the very beginning from the stock that we would see. And then we would have some of this 23 of this unrecaptured 1250 at 25%. So when we're thinking about this gain of 23, that's the 1250 unrecaptured, and we have that 4,000 of long-term capital gain for a total of 27. All right, let's look at it quickly from Bailey's perspective. So from Bailey's perspective, the amount realized is the fair market value of the new asset. So if we come back up here, the new asset fair market value that she's getting is 337. So we have 337 fair market value of the new asset plus any boot received, which is the 5 in the stock. So 342 is what Bailey is getting, her amount realized. The basis in the property she's transferring is her adjusted basis in the old asset. So if we come up here, her adjusted basis in the old asset is 180. Oops. 180 plus the fair market value of the boot given to the other party. The boot given to the other party is the assumption of liabilities. So Bailey assumes those liabilities, so 208 is her basis in the property transferred. The realized gain or loss is the 342 then minus the 208 or 134. Here we have no type 1 boot that we've received. Okay, so it's 0 plus 5 equals 5, which is the boot received. So our recognized gain is the lesser of the realized gain or boot received. So our recognized gain is 5. The character of that gain is going to be unrecaptured 1250 at 25% because of the type of property it is. It's used in a business. We're sole proprietors. The deferred gain is the realized gain of 134 minus the recognized gain of 5 or 129. All right, and then lastly, we have the basis in the new asset. The fair market value of the new asset, 337 minus the deferred gain of 129 gives us the new basis that we have in the new asset of 208.